Hey guys, Dirk and Emily here with We Sell Oklahoma, coming to you from our living room.
Yay.
We get a lot of questions about, what is needed to get qualified to buy a house. And so one of the big things that we counsel people on is credit.
Yeah.
So we figured we would, we have a lot of really helpful information that we wanted to get out to a lot of people. And we thought this would probably be the best and quickest way to do that.
Yeah.
So today our topic is, what is credit?
Yeah.
And Dirk, do you want to kind of share with us a little bit about what that is?
Yeah. So a quick breakdown of it is like when you borrow something with an agreement to pay it back, and sometimes with interest. It doesn't have to be with interest. That has been brought up to me by Kenneth Wall at RCB Bank. He said, if you pay it off before your statement hits, no interest. So that's pretty much what credit is saying you're going to borrow money and pay it back.
Awesome. So what is your credit score?
Okay, so your credit score is run through an algorithm, which we'll kind of talk about later in a later video, but it's a run through and it's called your FICO score. So your creditors or lenders will send in your information to 3 different credit bureaus. They run it through the FICO algorithm, and what that score that pops out is pretty much a calculation of how responsible you are with money. So that 3-digit number can tell lenders on a quickness how responsible you are.
Okay, so basically an overview of credit is when I borrow money from a lending institution and I agree that I'm going to pay that back with interest, typically
With
usually.
interest, yes.
And so when we're calculating credit scores, how responsible I am with the money that I borrowed is what creates my credit score.
Exactly.
Cool.
And
So-
there's a lot of different things that go into that, but that's a pretty broad idea of what it is. And in our later videos, we'll break down like what exactly goes into your credit score, what each percentage of each option, what it makes your credit score out to be.
Yeah. Awesome. Well, so some of the questions that we get often are kind of along the lines of, what is the best way to build my credit score? If people don't have any credit at all, or if they might have bad credit.
Right.
I just spoke to a potential client yesterday who called me. And I'm so impressed with this because she was 18 years old. She had just graduated high school, and she was moving to Edmond to start going to college at UCO. But she wanted to buy a house, and so I started asking her a bunch of the qualifying questions. One of those being, do you know what your credit score is? And I'd say 99% of the time people say no, and that's okay. No big deal. But, one of the issues at 18 years old was that she probably didn't have bad credit. She just didn't have much credit at all.
Right.
And
A lot of that's based on history.
Mm-hmm.
So how long you've had credit and stuff like that is a big part of what your credit score is. And like I said, we'll get into that in a later video. But that is a good point of like younger people will have less history in it. So they'll have genuinely lower credit scores, but there's ways of building that up as well. So.
Right. Cool. Well, I wrote out one of the questions that I get often, and I want to read that and then kind of explain the answer. So the question is, I have a Best Buy credit card with a limit of $1,000. 3 months ago, I used my card to buy a new TV for $850. I've been making the minimum payments on time every month, but my credit score isn't going up. What am I doing wrong? So the answer to that, I would say, is your utilization ratio.
Yep.
Let's say for easy numbers, if you have a credit card with a limit of $1,000 and you use $850 of it, you are using 85% of your utilization ratio.
Right.
Now, the general rule of thumb is that you don't want to use more than 20% of your utilization ratio.
Yeah, like 20 to 30% is the general rule.
So in that scenario, because this person has gone well over that 20% utilization ratio, even though they are making the minimum payments every month, their credit score is going to be lower than what it would be if they had paid that all off the same month that they bought it. So I would say in that scenario, I would recommend that that person, pay it off as quickly as possible, make more than the minimum payment,
Right.
and just get it paid off as quickly as possible. Once you do get that bill paid off, then you will likely see your credit score increase by a few points.
Yeah.
Maybe even by 50 points.
Yeah, your credit can go up very quickly depending on how you work on it. And you can bootstrap your credit and make it come up much faster than what people believe. I mean, I've done it personally. Like if you really set your mind to it, you monitor it with like Credit Karma, stuff like that. You can really get your credit up very quickly if you work at it. Another question we get is, why do I have 3 different credit scores? And a lot of that is the 3 different credit bureaus all put out their own, and not every lender reports to all 3 credit bureaus. So they might report to 2 or just one of them, and so it may not show up on the other 2 credit bureau reports. So that's why there's 3 different bureaus, and they kind of combine all that together to get what your actual credit score is when they pull your credit.
So those 3 different credit bureaus, for instance, I want to give an example because this might help paint the picture. Let's say you have a car loan, and that car loan, when you are making positive payments on that car loan every month and you are paying it on time, that car loan may only be reported to one of the credit bureaus. So maybe they're reporting all of your positive payments to Equifax, but they're not reporting it to TransUnion or Experian. And let's say you also have a student loan, and maybe you have missed a couple of payments on the student loan. Maybe that student loan is only reporting to TransUnion and not to Equifax. And so all of your negative reporting might be on another credit bureau. So maybe your TransUnion credit score is really low while your Equifax might be higher. And then let's say you have a credit card, and your credit card, they might report to all 3. And so that's why you're going to see different credit scores from different credit bureaus. And that has to do with, where those creditors are reporting your either positive or your negative payments. Yep. To which credit bureau, and how that affects your score.
Right. And the same can go with collections. If you have a collection on one credit bureau, it may not be on another credit bureau, but it's still going to affect the overall power you have in your credit when you go to get a car loan or even a cell phone or insurance, stuff like that. So paying attention and monitoring your credit reports is very important to do.
Yep. So that those reportings may not be reflected in your credit score always, but they are going to show up on your credit report.
Yes.
For sure. Well, I think that's all the time we have for today.
Yep.
On this episode. Thank you guys for coming. I hope you got some helpful information about it. If you have any questions or suggestions on things that you want us to talk about, then email us at emily@weselloklahoma.com.
Yeah. And stay tuned for the next video. We're going to talk about what types of credit there are and why they matter. So
cool.
We'll see you in the
see you
next
next
one.
time.